Hello everyone, welcome to MEA's e-learning channel. The topic today we have is Introduction to Mutual Funds. As seen on the screen, mutual funds are collective investment schemes where money from multiple investors is pooled together and invested in a diversified portfolio of securities. So in a short one-liner, we can say it's basically pooling of funds. So a key word that you can use to understand mutual fund is pooling of funds, wherein a wide range or wide options are given to investors to invest in varied schemes depending upon short-term goals, long-term goals, liquid goals, etc. It's basically professionally managed. It has a diversification opportunity among schemes and economies of scale. That is what is basically the benefit of mutual fund, investing in mutual fund. And as they always say in the advertisement, like mutual fund is a right way to start investing indirectly into the stock market. So all those who are wary of stock market, they can always go in for mutual fund as an investment option, wherein they can have the benefits of stock market investments with minimizing the risk. So this is where mutual fund comes into the picture. We come to the key features of mutual fund. There are many features of mutual fund, but some of the key features that you should be knowing of is diversification. Mutual fund is practically giving you opportunities to invest in n number of schemes as per your goals, as per your financial goals, as per your want, etc. So it allows you to have different types of classifications of schemes, starting from liquid funds, equity funds to debt funds, hybrid, balanced as we say, and it helps you to mitigate your risk. One of the important features of being diversified is that you scatter your risk, practically you mitigate your risk. So that is basically diversification, and it's one of the prominent features of mutual fund. It's also professionally managed. It is practically managed by professional fund managers who have 10 to 15 years, maybe 20 to 30 years experience in stock market investments or investment arena, and they are research professionals. They research their area of investment and then recommend you funds based on which you invest your money and you earn a handsome returns. And they also go for fund evaluation, and they are what you call as licensed mutual fund agents, and they have eligibility and qualification to manage the corpus. So they have professionally managed. That is one of the benefit of mutual fund also, that you get people, you give money to those people who you know the market or know the investment avenues and invest your money wisely. So that's where professional management comes there. Then you have accessibility. Mutual fund is accessible to practically everyone. You can start a simple sum of rupees 100 to 500 to 1000 to 10,000. You can go as per your ability to go for SIP, that is systematic investment plan, or you can also go by lump sum in case that is a way of your investment. So you have practically low investment, minimum low investment to maximum investment. So anybody, mutual funds are accessible to anybody and everybody. So that is where the accessibility feature comes into the mutual fund. Other than that, key mutual funds, other than diversification, professional managed, accessibility, mutual fund also gives you a lot of security. Security in a sense, like it goes by the market trend, it gives you the inflationary rate of money, it gives you a handsome return provided you invest in different schemes as per your financial goals. So it is a combination of fund where you get the benefit of market, where again mitigating the risk that you encounter in the market. We come across the next thing, that is risk. So apart from the features, we also come across what exactly the risks are of mutual funds. As always, security investments or investments always comes with a risk, that is market risk. So mutual funds are also subject to market risk. You can always see that in the advertising tagline, that read the mutual funds documents carefully because it is subject to market risk. So market risk is something which is inevitable for the mutual fund investors, as well as it's inevitable for all the investors. So you do have in relation with economic conditions, political events and other factors affecting the financial market, it also affects mutual fund, because mutual fund investments are practically in markets. So anything and everything that affects market affects mutual fund also. So mutual fund has market risk. It also has liquidity risk because it faces many challenges, particularly in time of market being bearish or bullish. So if the market is bearish, it come across liquidity risk. It affects the ability of selling the investments. The redemption or the repay of the mutual funds can also be difficult in a stressful, timely market condition. So these are some of the basic risks that you encounter in all the investments. Other than that, you also have a concentration risk. For example, the mutual fund invests in particular sector, theme, industry based on some performances, etc. So it has a limitation of being concentrated in one area, one industry, maybe a sectoral concept or a thematic concept. So that also can be a risk factor in case that sector or theme is not performing well. So your mutual fund also encounters risk, and that risk is what we call as concentration risk, because you are concentrating in one of the sectors, theme, or maybe you are concentrating on index. So if you are making your mutual fund investments in one area, one theme, one sector, then you come across concentration risk. The next one is management risk. A lot of mutual funds performance depends upon fund managers, their performances, their experiences, their qualification, their decision making skill, etc. So it has to lot of things to do with how your fund manager manages your money, what kind of decisions the fund managers take, whether they underperform, whether they overperform. So a lot of mutual fund returns and mutual fund appreciation, capital appreciation depends upon fund manager. So if the management is not up to the benchmark, then your mutual fund will suffer losses, and that is again what we call as management risk. So these are some of the risks associated with mutual funds. Again, there are many more other risks like interest rate risk, because mutual funds you also have debt funds as one of the types of mutual funds, and in debt funds you get interest. So you come across interest rate risk also. If the market is not good, the interest rate may fall, and when the interest rate fall, that affects your mutual fund debt instruments investment also. So apart from these, there are many other risks which every type of investment encounters in security markets or in market. So these are basically risks that we can say, okay, not particular to mutual fund, but yeah, it also comes with mutual fund investment. Now, according to risk, we saw what are the risks that we face in mutual fund. There's another side that we face mutual fund fees and expenses. So like before, because it is professionally managed, so you have to pay professional management fees. So that is one of the expense. Then you have sales charges, redemption fees. Like for example, you have an entry load or an exit load. If you're entering into a mutual fund, you're supposed to pay an entry fees, an entry load. The terminology that we use in mutual fund is entry load. If you're exiting a mutual fund before the condition, then you have to pay 1% exit load. For example, you are exiting the mutual fund before 1 year, so you have to pay 1% exit load. If you're investing before 1 month as per the terms and conditions of the fund, then you have to pay 1% exit load. So these are expenditures which you encounter when you go for mutual fund investments. So whenever you go for mutual fund investment, you have to know about what are the risks as well as what are the expenses. So every mutual fund gives you a expense ratio depending upon like total cost, total annual cost encountered by the fund, and that is what comes under the expense ratio concept. So you have, as an investor, you also have to pay attention that there is not only a risk factor in mutual fund, but there is another side to it that you also have to see what are the expenditures you will incur while investing in mutual funds. Selecting the right mutual fund, knowing all these features of mutual fund, knowing about the key advantages of mutual fund and what are risks about mutual fund and what are the expenses and fees structure in mutual fund gives you an idea how to select the right mutual fund. So one of the best way to select a mutual fund is to first identify what is your objective. You want to, what is your investment goal, short term, long term, medium term, what is your risk tolerance, what is your risk appetite, what is your risk capacity practically. Are you an aggressive risk taker, you are a moderate risk taker, you have a low risk taking appetite. What is your time horizon, like you want to invest for months, years, in long term basis, in liquid funds, in balanced or hybrid funds, etc. So this is one of the right way of selecting a mutual fund, that you go by your identified objectives, then you research on the funds that fulfill your objectives. So you have to evaluate the funds on the basis of their investment strategy, performance history, risk profile, fees and expenses, management team, particularly who's the person who's managing the fund, that is a fund manager. So you have to research on fund manager as well, his market experience, the kind of corpus that he manages, how has he outperformed the benchmark, whether he has underperformed the benchmark. So these things you have to read, and all these you find in mutual fund documents. So you have to read the documents carefully. Now consider the diversification. For example, whether the mutual fund invest in all the areas of market, or whether they are concentrating on few areas, for example like equity, debt. So if the mutual fund invest more than 70% in stock market, then it becomes an equity base. So then your diversification is very less, you have more fluctuations, you have more risk. So all the equity market investments have high risk. If the investment is in debt markets, then the risk is low to moderate, and in both then you have a comparatively less risk or moderate risk, or high to moderate risk. So considering the diversification, how well the portfolio has been diversified, how well the funds has been distributed in different sectors, themes, equities, debt, etc., you have to select the right mutual fund. And then comes to monitor and adjust. You have to have a follow up. You have to regularly review your net asset value of mutual fund. You have to see what are the changes that they have made in the mutual fund portfolio in case. You have to also see what is the market benchmarks of mutual fund, what is the comparative benchmark of your return as well as the market return. You have to evaluate whether you are achieving the goal for which you have set out, how far you are to achieve that goals. So you have to monitor and adjust your portfolio as per the market condition, or as per the mutual fund investment criteria. So this is one way you can go about selecting the right mutual fund. So in summarization, we can say you came to know about what is mutual fund. In one line you can say it's a pooling of money. It's like you'll be pulling the money right into the market. It has a lot of risk factors. It also comes with fees and expenditures, so you have to pay attention to the expense ratio. It has a lot of benefits along with it, but then you have to consider everything, right from objectives, research, diversification, and follow-up and adjustment of portfolios in selecting the right mutual fund. I hope you understood the topic. Thank you very much.